Hello.
There you are.
Hi. Sorry, I was trying to get. I was planning on coming in early, but I was trying to get this recording software thing to work.
Oh, I know how that can be.
So there's sometimes where I've had this all set up, and I thought this is perfect, it's gonna work, and then I get done with the video, and then there's like video but no audio, or there's one time it was like no video but audio, and I'm like, what? I don't get
Well,
it.
I'm a simple guy. I just use Zoom, and
Yeah.
that's just a couple of buttons, and it seems to work. I mean, I
Mhm.
don't know I have not been able to take the recording and do anything with it, but it does
Yeah.
come to my inbox, and I can then see it.
Yeah. Yeah, this software that I'm using here, it's supposed to have a recording feature, and then this time it didn't. Last time it did, um, and this is the same software that he typically will use for client meetings and stuff. And so I just out of habit, this is just what I use for all video meetings. I know everybody uses Zoom, and I was telling somebody not too long ago about that. I said, I think I'm probably the only one who doesn't use Zoom, and they sort of looked at me funny, like, yeah, you are weird. This everybody's, over the especially.
Well, you aren't because my whenever I have Zooms with banks, don't use Zoom for some reason because I guess for security issues.
Yeah.
And also, I sit on a board of a company that uses Google Meet or whatever. I
Mm,
think it's Meet, and
yeah.
that's really kludgy. So,
Yeah.
um, but this seems to work. I'm not. I mean, my picture looks a little fuzzy, but if I look okay to you, then we're good to go.
Yeah, I think so. I think your picture is a little bit fuzzy, but I don't know what accounts for that. I don't know if it's like my connection or your connection or what, but it works for me if it works for you.
Yeah, absolutely. So,
So yeah,
um,
well, thank you for doing this again. I know I originally talked to you about trying to meet back in January, and we had a couple of false starts there, and then in February, my wife and I came down with COVID. We finally got COVID,
oh my goodness.
and
Oh my goodness.
yeah, it was. I mean, we survived, obviously, but
Mhm.
it felt like a really nasty flu. Is how we experienced it.
Well, it was going around this neighborhood, and I don't know that I got it. I was kind of under the weather. I was just very tired for a couple of days. I mean, my
Yeah,
friend across the street had it, and she had a pretty just a bad cold
yeah,
for a few days. Then it went away. Then it came back, and then
mm-hmm.
it went away.
Right.
And in the meantime, I had a couple of days of feeling tired, but never even got myself tested. So maybe I had it, maybe I didn't. But as far as I'm concerned, it's like any other disease right now. It's out there, and
Yeah.
you got to hope you don't get it.
Yeah, I was talking to some people who do product development at some different life insurance companies. One was an independent consultant, and he was saying that the word on the street is that a lot of insurance companies now are just looking at they're looking at COVID as this mortality event, but not a trend, not something that's going to stick around for be something that's going to be very concerning for decades or whatever.
Very, very interesting because I've actually done a fair amount of well, and you probably saw the piece I did on COVID mortality a while ago, and
Yeah.
and and I did another piece for Cap Acuity, who was interested as to whether um, kind of an update to that and its impact on the insurance industry.
Yeah.
And at that point, I had said, looks like it's going to be a kind of a non-event.
Right.
Um, on the other hand, it did seem like the secondary effects of COVID were having a some kind of troubling impact because excess mortality non-COVID
Yeah.
had increased a little bit. Um, they've asked me to actually look at it again because that trend has gotten worse.
Yeah.
And I don't know if you've seen the most recent Society of Actuaries white paper on it, but
Yeah.
it looks like life insurance claims are up in the fourth. We're up in the fourth quarter of 2021 by 25 to 40%,
Yeah.
which is not COVID specifically, but it does
Right.
seem like there's deferred medical care, there's um, socioeconomic impact,
Mm-hmm.
and maybe that's going to be passing through. But on the other hand, if people also deferred getting looked at for things like cancers and other things,
Yeah.
that could have a much longer lasting impact on mortality claims. And so the people I've talked to in the industry are moderately, but not overly concerned. But
Yeah.
they also, and this is something I didn't realize
Mm-hmm.
until I started talking to more of my friends within the carriers themselves.
Yeah.
They had been stockpiling cash,
Yeah.
and they had been just sort of adding to surplus,
Mm-hmm.
so that they were ready. They were really ready when
Right.
COVID happened. Not that they, I mean, in some sense, they're always ready,
Yeah.
but in this case, I guess as they saw the signs, a lot of them were stockpiling
Yeah.
cash reserves to weather the storm, and they seem to have. So,
Yeah. So there was some, I don't know if I call it news, but there was gossip maybe going around for a while about how insurance companies weren't doing so well, and the news media tends to blow these things out of proportion. And life insurers, are they going to pay your claim? And
right.
and I thought, well, let's think about this. And somebody had asked me about this, and it was actually I was on a internet forum, and the forum owner was like, "What do you think about this?" And I didn't know people thought about this. I thought life insurance, nobody really thinks about life insurance. I gotta drag people kicking and screaming to come and meet with me. So nobody really wants to, but there's people who are interested in this stuff.
Oh,
And
absolutely. There are people that are interested. I mean, people in my world are very interested in it,
yeah,
and um, yeah. In fact, I have a friend, and he had early on, actually, not so early on, but
yeah.
somewhere around in the middle of last year, said to me, I'm thinking of shorting um, all these insurance companies because I think they're gonna just be bleeding money soon, and I can make a bundle. And I
Right.
said, I would think twice about that. I mean, because the guys who run these insurance companies
Yeah.
really do know what they're doing,
Right.
and they've been through wars and plagues and all
Mm-hmm.
kinds of things, and they're still around hundreds of years later. So,
Yeah,
um,
especially the guys, the CEOs who are like the chief actuaries, and they also happen to be the CEO, or or they were the chief risk manager, chief risk officer, or whatever, and then they got promoted into the president position or something. Those guys know what they're doing.
the other point I made to this guy is that insurance companies are much more sophisticated than you would think.
Yeah.
In particular, they're very, very good at attending to enterprise risk. And
Yeah.
so many of them, and Pac Life was the one that I'm most familiar with, but I think the others as well have been balancing their books.
Mm-hmm.
They have been trying to increase their annuity exposure to balance out their life insurance
Oh, okay.
exposure, so that from an enterprise standpoint, um, the longevity insurance is balanced with the life
Life insurance,
insurance,
right?
and and again, I don't want to use a too disparaging an analogy, but your local bookmaker, when he takes books, tries to balance both sides of the ledger, and
Right.
so that he's not going to lose because one team wins,
Right.
and all the money's on that team.
Sure.
And again, insurance companies are not in the gambling business, but
Yeah. Yeah.
they do attend to balancing and offsetting risks.
Sure. I mean, they you can see, you can see how that would work, where you're hedging longevity risk both ways. Uh, if people live, that's good. On the life insurance side, you want people to live long lives. I don't want not that insurance companies want people to die, but on the annuity side, it is hedging the other side. So the longer they
Exactly.
live,
Exactly.
the more they got to pay out.
Exactly. I mean,
But
unlike a lot of industries, I mean, I really believe in the insurance industry. I mean,
yeah,
I'm biased, of course, being an
sure,
actuary, but
sure,
um, I do believe that insurance companies have been a tremendous boon to society
hmm,
and the safety and security of individuals for hundreds of years,
yeah,
and they really haven't varied from that mission.
right,
Not the big ones that have been around for a while. So
yeah. Yeah, I mean, I don't remember exactly how much off the top of my head, how in terms of policy sales, number of policies. I know there's been some reports that there's fewer people buying life insurance now, but compared to maybe like 1970s or something like that, but that the size of the policies are getting bigger. So people are buying like larger policies, funding them more heavily, but the number of policies is decreasing, which is um, I don't know. I think that's kind of sad that people don't see the like that more people aren't seeing the value in the insurance and buying and there's big controversy over not just life insurance but annuities too. I think Moshe Malevsky, I think, is the annuity guy who's is always talking about longevity risk and all this, and you should be buying annuities instead of trying to guess your way through, this income planning stuff. And he gets a lot of pushback about this because of even from financial planners and investment advisors. You don't need annuities; that's just a scam. And this guy does, he teaches retirement, I can't remember exactly what his title is, but I mean, he's a professor. He's not
yeah,
connected, to my knowledge anyway. He's not connected to the industry in terms of sales or anything.
no, I'm familiar with his work,
Yeah,
but here's the thing. I mean, I what you're saying is absolutely right, um, but and I say but you can't look at it in isolation.
yeah,
Yes, annuities hedge longevity risk, and yes, life insurance hedges a different risk. It's really how you put it all together, and it's got to be holistic. And that's actually where my current research
yeah,
is trying to use different multiple buckets.
yeah,
And annuities, I view annuities as something you do sort of towards the end.
yeah,
Like I would be if, again, I don't give advice, but
sure.
as I think about your path through life or through your working career,
Hmm.
life insurance is something you probably ought to get early in your career,
Yeah,
where it's cheap, where you can get where you have time to build up significant cash value because of the passage of time and the
hmm,
effect of persistency and all the other things that
yeah,
insurance companies build into their cash flow, cash value accumulation
hmm,
formulas. And what's the real risk? The real risk you're caring about is that you died prematurely,
yeah,
and that's what you should be insuring. Now, annuities don't make that much sense at younger ages. But as you get towards where you're starting to plan for retirement, maybe into your 50s, and you're thinking, oh boy, I'm not sure I'm going to have enough to last if I really live a very, very long time. So
yeah,
that becomes a new risk. But again, it kind of emerges later in life when you get to your 50s and you're suddenly really healthy,
right.
and you think, oh my goodness, do I have enough to live on till I'm 95? And that's when you ought to be thinking about a QLAC
Yeah.
or some kind of annuity. I mean, I personally believe in that in addition to commercially available annuities, which have gotten very, very aggressively and priced,
Mhm.
um, you also should think about charitable gift annuities, because then you can get an annuity at the same time you're deploying some of your resources to worthy charities and get a tax deduction to boot.
Sure.
The numbers they're not nearly as cheap as a commercially available annuity from an insurance company,
Right.
but everybody's different, and they
Sure.
they, they all have different objectives and desires. And if legacy and helping out a charity or immediate tax deductions are an overwhelming concern, then that's something to consider too. But the point is, there's no one solution to everybody's problems.
Yeah. So that's and I think that's the. I tell people that prospective clients and clients that are on my email list, you really have to be careful about what you're finding on the internet, because it's pretty, the range of advice is pretty narrow, and I can't tell you the number of times that I've had in the past that people have just shot me a one-off email. And these weren't people who were really interested in any sort of life insurance planning, but they were just shooting off an email just to say, essentially that my job is worthless, and all people need to do is buy index funds, and they'll be set. They don't need to worry about anything else. And
Yeah.
I thought, that is, wow, what a narrow range of advice that is. Like, if everybody did that, would everybody just be fine? Why is there a market for all this other stuff then?
Yeah, well, that whole index funds and passive versus active investing is
Yeah.
is very interesting, and of course, I'm a big believer in passive investments, index funds, because I can't pick stocks, and I
Yeah.
can't, and even and knowing how hard it is to pick stocks, I also know that it's almost impossible to pick managers who can pick stocks.
It's really hard.
There's one step removed,
Right.
making the problem even more difficult. Now I not only got to evaluate the company, I got to evaluate a person's ability to pick the right company.
Yeah.
To me, that's impossible. On the other hand, passive investing and index investment wouldn't work if there weren't lots and lots of managers all out there trying to beat the
Yeah.
markets. So
Sure.
it's kind of a paradox.
Well, there was some research by, and I can't remember off the time. I think his name was, gosh, I'd probably butcher his name. I can't remember exactly how to pronounce it. But there was some research done by a professor. He basically gathered like all of in the universe of stocks. Like, he put together all publicly traded stocks and combed through the returns for these things going all the way back to the 1920s or something like that, and found that something like, I think it was like only 4% of all publicly traded stocks were responsible for all of the net gains of of various stock markets since like 1926 or something like that.
Well, to me, that's a corollary of the 80/20 rule and
Yeah.
fat tail distributions and Pareto distributions,
Yeah.
which is what I believe governs the operation of a lot of markets,
Mhm.
and makes making your way so difficult. I mean, I
Yeah.
talk about that in my book
Yeah.
and so forth. But I mean, the 80/20 rule works, and in many, many circumstances, and it is a function of the fact that these distributions are really, really unruly, and you really are got to be careful in trying to beat it or calculate.
Right. Yeah. So going back to something you had said, that you'd mentioned earlier about insurance companies being really good at what they do, and some of these managers being good at what they do. I was reading some numbers about mortality statistics and stuff like that, through especially from 2020 and 2021.
Mm-hmm.
And I had heard about this. There was a big news story about One America and their group term life insurance business that was really suffering there because their mortality rates had gone up like 40% or something like that. 30 or 40, I can't remember, 30 or 40%, something like that. And a lot of news, a lot of news organizations sort of jumped on that, and there was,
Yeah.
it went viral basically, and that's what I think kicked off, a lot of these bloggers that were talking about, life insurance companies are in trouble because the mortality rates spiked, and I thought, I haven't seen that at the companies that I write business for, but maybe there's other companies that had. So I was looking around, and I saw I did see the industry statistics of something like that there were, I don't know, like $6 trillion in policy reserves or something like that, and like $400 billion in additional surplus, and the death claims were $100 billion. like
Well, that's right.
like
That's
wow.
right.
So,
That's exactly right. I
yeah.
mean, you want to look at the biggest pots of cash out there in America. I mean, people talk about BlackRock having I
Yeah.
don't know how many trillions of dollars under management,
Right.
but the truth is that those big insurance companies, they're the ones with in huge piles of liquid cash,
Just
and they
absolutely
do it so
massive.
that they can manage risk, and that's
Right.
what it takes these days.
Right.
And that's so you're right. I but it's interesting that and again, I think it was One America. I think it
I,
was the
yeah, I
thing.
think, yeah,
There
it
were
was.
a couple of companies that did get caught
Hmm.
unprepared,
Right.
but they were the small ones, and they weren't the ones that were run by actuaries that really know what they're doing
Sure.
and know that mortality is an unruly beast.
Yeah. And there's something different too about, I think, and I'm not saying this that problems don't crop up in the individual market, because I think you mentioned that mortality has risen, and I've seen that too, like mortality has risen in the individual market, but the group market is also very different, just in that it doesn't get underwritten the same way. And
Right.
so they're not looking at if you've got some sort of medical condition that would rate you as substandard risk or anything. They're just, we're pricing everybody based on, this group. And
Well, that's true. And think about it. Think about fire insurance companies.
yeah.
I mean, they try not to insure an entire neighborhood, because if one house goes, maybe other houses in the neighborhood will go.
Sure.
Well, the same is true with something like COVID.
Yeah.
And I think that's where some of these small group insurers got into trouble, is not realizing that it's not just if one person in a neighborhood gets COVID and dies,
Hmm.
there's liable to be others, and if they're taken, and those people might all work at the same employer, so
Oh yeah.
there is a lack of independent risks or correlated risks that unsophisticated group insurers might not be fully attentive to. So
Yeah. Yeah.
it's complicated business we're in, David.
Yeah. Yeah. It's hard to, I mean, and it is hard to, I did have some questions for you about that, if you don't mind talking
Sure.
about I know last time we talked about your newer book that you have that's out, but I was wondering if you would mind talking about the other book that you had, the previous one that you published.
Oh,
From
what's your future worth?
Yeah.
Yeah, sure. I mean, I haven't talked about it in a while, but
uh,
that one was a more generalized
mhm.
generalized approach to looking at all of the not just the hazards,
Yeah.
just the paths you take in life,
Hmm.
and you really got to kind of imagine the future,
Yeah.
and imagine the possibilities, and then get some get some help to first you got to define the question, and I
Yeah.
can't even remember the 5 steps I laid out. It's been so long, but basically you have to identify the question you're trying to decide on.
Yeah.
Whether it's to change jobs or
Hmm.
uh, move from one city to another, and then kind of do your due diligence and frame the question, figure out the alternative paths, and then imagine the possibilities,
Right.
because you don't want to get hooked into a path that says this is going to happen.
Yeah.
You got to say this might happen, and this might happen, and that might happen, and you
Right.
got to, and really the key point in that book is that you really don't have to do anything other than evaluate which path is better.
Yeah.
So that was kind of the big message in that book, is that you look at both paths,
Mm-hmm.
or maybe there are three paths, but you
Yeah.
look at the limited number of alternatives
Mm-hmm.
that you're facing, and then imagine the possibilities
Right.
of how each of those paths could manifest.
Yeah.
Try to assign probabilities, or at least likelihood.
Yeah.
Is that a real likelihood possibility? Is
Mm-hmm.
that a very unlikely? And then think about how you would feel
Mm-hmm.
um, if those possibilities, one of the possibilities associated with one path compared to the other path manifested. And that last step has is a function of how you feel about the present versus how you feel about the future. And that's where that's where I got I guess I got in a slight bit of trouble with my employer at the time, who was promoting the book, because when I said that, um, I guess it was the president of the practice leader of national. What do you mean? What do you mean? You're going to let people choose their own discount rate? I mean,
How
we
dare
we
you?
tell them, we tell them that's what we do. That's what we as actuaries do. We tell you
Yeah.
how to compare the value of the future versus the value of the present, and that's where I had a real philosophical dispute, because
Yeah.
I believe that everybody is should be able to determine their own personal rate of discount. In fact, I even wrote a blog right after that uh,
Mm-hmm.
uh, book came out in defense of personal discount rates.
Yeah. So, and the reason I didn't mean to surprise you with it, and I know you said we should continue a discussion here. I I was thinking about it more recently because I've had clients, doing client reviews and things for people, and I've had people that have asked me these questions about, Dave, what is, I'm thinking about doing like this or this. One client was thinking about doing some sort of real estate investment. I don't know if I should pay down this, pay off the mortgage on this thing, or if I should go do this other thing over here. And I said, you know what? I got a book for you. And I've been recommending it simply because those kinds of questions keep coming up. And a lot of what people's decisions are, it's not, you get people who are asking about, IRAs and things like that. And that's not my main business. My main business is life insurance planning.
Yeah.
But a lot of people are having their choices are not so much. They're not asking about what kind of what's a good investment. Where do you think I should put my money? They're more asking questions about. Well, I've got these 2 or 3 or 4 different things I could do. I don't know what to do. Like I just and it's such a personal decision. That's not something that I can make a decision for them anyway. Like I had another client who had asked me about a couple of weeks ago, in fact. She had asked me about. She's trying to make a decision about whether she should move to a different state or something for a job, and if she does that, then it's going to mean uprooting her life, and she's going to have these costs and this. And I said, well, what happens if you stay where you are? Well, I could do this, but maybe the income's not as good there, and I just don't know what to do. And so, I recommended your book. I said, read the book, and I hope that helps. But those kinds of decisions are decisions that people face all the time, and there's no. I have not seen and I started in 2004, and I was not just when I started out. It wasn't just life insurance. It was also the company I started for. They wanted me to be a registered rep. They wanted me to do life insurance, and then they wanted me to put me in a CFP program. So they wanted me to be a certified financial planner, and and the last part of that was, even back then I said, I can't make decisions for people. How am I supposed to make decisions for people about like what mortgage they should be taking out?
Right.
I mean, should you choose a 15 or a 30-year mortgage? Is there a right decision on that? I mean, how am I supposed to do that for somebody? What I would do isn't necessarily what somebody else would do. So,
Well, that's exactly right, David. In fact, those people were exactly who I wrote the first book for.
yeah,
And it's really when you're facing a decision, either or A, B, or C.
right.
That's when the kind of the technique or the steps I laid out in that book make sense. And it was interesting because I thought there would be a lot of that,
Yeah,
and there was a fair amount of interest and
yeah,
a fair amount of people, but everybody kept gravitating to, no, I got a 401k,
yeah.
and I got to figure out how to manage my portfolio and what do I do about
Yep.
that. And that's just a more complicated, bigger set of issues. And yeah, I mean, there are either or decisions with
Mm-hmm.
respect to money, and that's so you can kind of boil it down to
Yeah.
the techniques and what's your future worth to make those decisions.
Mm-hmm.
But that's really why I wrote the second book. But it's gratifying to me to hear that those conundrums still exist. People are coming to
I,
people like you, and you're
I,
recommending my book. So
yeah,
it's wonderful.
I think that there's a lot. Well, thank you for writing it, because I had, before reading that book, I had sort of, my wife and I had a sort of a decision matrix, is what we called it. We had a process for making decisions, but it wasn't as fleshed out as kind of what you presented in the book. And some of it was nice to get confirmation that at least some of the stuff we were doing was right. And but there was no God, there was no, in my career, I had just not ever come across something that was like that actually encouraged people to make decisions for themselves. And that became, shortly after when I started at a major life insurance company. When I left, I started down this path of not, one of the disagreements I had with the firm was that I couldn't. There was a lot of financial decisions that I could not make for clients. That they had to be, and it couldn't be just an artificially limited choice. Like you can make a decision between A, B, and C. Well, what if what if it's not A, B, and C? What if it's A through F or whatever? And we're artificially limiting those choices to them. What if the product doesn't exist at that company and they need a product from some other company? Or what if they don't need any product at all? And I started going down this path of, I call it self-leadership. And I think that is there's a huge difference, just an ideological difference. When you mentioned that, your employer at the time, had, kind of gave you some pushback. Like, we're the ones that are supposed to tell people what their discount rate is. And I think that sort of top-down authoritarian viewpoint dominates, not just in finance, but in other industries. It dominates, and we ignore this idea that people can introspect, that people can make their own decisions. They could turn inward and rely on themselves as an authority versus, constantly having to be told what to do.
I agree with you, but I also think that it doesn't come from a bad place. It often comes from a. I think there's two things involved. Is a feeling like, well, the client, the patient, the employee really is all over the place, and they need to be contained, and they need to have their choices limited.
Yeah.
And we're going to be artificially limiting them, but on average, that makes sense. And so again, I think it comes from a pretty good, benign place, but it also fails to take account of the idiosyncrasies of each person.
Yeah.
And because so much is, and you could do all the stats you want and say, for example, taking a loan from a 401k plan is a bad idea to buy it,
Yeah.
but it's not always a bad idea. And it's not, and maybe on average it gets people in more trouble, but
Hmm.
advising to the averages, maybe that's inherent in the business model of
Yeah.
a lot of these firms, but it doesn't do the customer a service, because like I say in my book talks for this one, if
Hmm.
you've seen one financial plan, you've seen one financial plan.
Yeah, everybody's situation is a little bit different, and there is this sort of I guess the whole borrowing against a 401k, just to take an example. Advisors, that the arguments against that I typically see are, if the stock market's up, you don't want to be borrowing against your 401k. You want to leave the money in there, and if it's down, you don't want to cash out your losses. But it sort of ignores, like, well, what would you be doing with that money if
Right.
the returns are low? And you're going to always pay interest on whatever 401k loan that you take out. So if it was let's say an 8% loan rate, if the market's doing 4% and you can take out a loan and pay that back at 8%, but it's going to wipe out a whole bunch of debt that you have. I mean, yeah, I could envision scenarios where that might actually be a good idea.
Well, absolutely. It's really complicated, and
Yeah.
I mean, this is where it's interesting. We talked about this. I just was on a chat with a guy who runs an acute financial care company,
Yeah.
and and we were talking about that, because there are all kinds of reasons why people might need money that, when you look at it on a present value basis, it's a no-brainer.
Yeah.
I mean, suppose you need your car to get to work
Hmm.
and to earn a living, so it's your future income stream.
Yeah.
Well, you might need to take a loan out from your 401k to get your car fixed or get a
Sure.
new car. So there's all kinds of reasons that are not going to be apparent from the data, that what these rules of thumb just don't necessarily work all the time.
Yeah. Yeah. And in some cases, if you look at it from the perspective of, a lender, for example, you might say, well, I need money, for a loan, and I could take a loan from a 401k, or I could. But if it's suppose you need like a large sum of money, and you look at different, you look at going to a bank, or a lender to borrow money from a bank or something. Um, there are situations, and there's situations where, a client of mine years ago was in a really tough spot, lost his job, needed money, didn't have it because his income was shut off, and so he had money saved up inside his life insurance policy, and that was a source of funds for him. Now, he wouldn't have been able to get a loan economically. It wouldn't make sense for a bank or anybody to lend him money, right?
Right.
It made it, but he at the same time, that's when he needed money. And people say, don't borrow against your life insurance, it's risky, don't do that. Well, what's the guy gonna do? He needs
Well,
money.
absolutely, and I'll tell you this, David. I was actually going to. That's where I was going to go.
Yeah.
Interesting is to talk about loans from cash value life insurance, because I actually have never taken a loan from my 401k.
Yeah.
I don't think, maybe I did, but if I did, it was just once. But I've taken at least 3 loans from my cash value
Mm-hmm.
life insurance policies over my career,
Yeah.
and it is fantastic. I mean, it's immediate money.
Mm-hmm.
They send you a check right away.
Mm-hmm.
There's the spread between what you pay. It's super cheap money, because a lot of times there's only a 1, 2, or maybe 3% spread between what you pay, the loan you pay back,
Mm-hmm.
and what gets credited back to the cash value.
Right.
So even if the loan is 8%, and you
Mhm.
say, "Oh, that's a ridiculous
Right.
interest rate," but if the crediting rate is 5,
I mean,
on the
that's a
cash
positive
value,
spread.
and
Yeah.
and it's really a 3% loan that you're taking.
Right.
That's
Oh, it's
so
a tremendous value.
and again, back to the point I was making earlier.
Hmm?
If you start buying, if you buy a life insurance policy early in your career, that's you're going to have that cash value available when you need it. I mean, like I said, I bought my first policy when I was 23 years old.
Yeah.
And by the time I was in my 40s and I had a house and it needed renovations and other things, I mean, that money was available
Yeah.
after 20 years of accumulation. It was a pretty good sized cash value.
Yeah, I mean, my wife and I did the same thing when with our policies. We that was a down payment on our house. That was us financing two different vehicles instead of taking out loans for that we would have paid whatever interest rate we would have paid at a bank. That's money that we feel is money that's coming back to us because it's from our policies that we own, where we're whole life policy owners, and it's almost like you're paying interest to a company where you're a member or a part owner of. It doesn't feel so bad taking out loans like,
Right,
when under those circumstances.
right.
And it's just so we've used our cash values for all kinds of different things, and not just to buy things. I mean, some of it we've made investments in other things too, but it's always been it's been one of those things where I've always looked at it like some part, like a part safety net, part foundation, from which you could do pretty much sky's the limit. If your insurance policy is the worst that you can do, then it's still pretty good.
Well, and again, this is kind of the new research
Yeah.
that I'm doing with Barry Sachs, who's my collaborator on the research around coordinating a reverse mortgage
Mm-hmm.
with drawdown from a 401k,
Yeah.
and we're adding a third bucket, which is a cash value life insurance. And one of the interesting issues that we're struggling, not struggling, just sort of trying to get our arms around
Yeah.
is, when does it make sense to borrow? Because this third bucket is there in retirement to help you meet unpredictable contingent expenses
Mm-hmm.
or sudden spikes in your liquidity, because you don't want to be selling your portfolio to draw it, to suddenly meet a need,
Right.
but a sudden liquidity need. But the issue of when to borrow and when to take out cost basis is a tricky thing, and that's
Yeah.
so it's not just the loan that's available. It's also because sometimes you're going to have an expense that you really are not in a position to pay back,
Yeah.
and that's when withdrawing the cost basis. If you've been paying into the policy for years and years and years,
Yeah.
you can withdraw that cost basis or some of that cost basis without forcing a surrender of the policy, and
Right.
and that's yet another feature of cash value life insurance that I think is underutilized and underappreciated.
Yeah, I mean that's a big selling point that people make about Roth IRAs, even
Right.
though they have like a lot lower contribution limit. Not that you should sit there and compete one against the other, but I mean it's a big selling point for Roth IRAs. But sometimes I guess somehow it's forgotten when it comes to life insurance, is it gets the same tax treatment.
Well, not only that, but when that again, it's a net against the death benefit, I guess. But
Yeah.
that death benefit comes through cash, tax free. So it's
Sure.
not like you're increasing your future taxes in any way by
No.
withdrawing cost
Yeah.
basis.
No. Yeah. So I mean, and that is the um, you had said that your research has kind of moved towards the ideas that you were talking about in the Money Mountaineering book, and I think that those are like two different areas I think people struggle with, and I
Mhm.
and there's sort of this need for advice that I mean, a lot of stuff in finance is very specialized, and so I do see the value in that. I've got, I mean, and of course, but of course, I also see the value in people making their own decisions. And I think there's got to be like some sort of way to meld those together,
Mhm.
because I'm very much opposed to this idea that everything should be top down, and I think that's what causes a lot of problems too. Is people just sort of stop, they turn their brains off, and they let somebody else do the thinking for them. I think it's how a lot of people get into trouble. Even if they have a lot of money, they still get into trouble.
I think
Um,
that's
and so, I mean, do you have any advice about like, how people would, or maybe recommendation, maybe not formal recommendation, but any ideas about like how people, like how do you take advice from someone without letting that advice take over your whole life?
how do you take it? Well, I mean, I that's something I talk about directly in the second in this
Yeah,
new book, which is you know principle three,
yeah,
which is getting advice, getting help when you need it. Well, the most important thing is figure out exactly what help you need. So
yeah.
limit the advice you're getting to exactly what you can't figure out by yourself.
Mm-hmm.
And like I said, when you hire a lawyer, you hire a lawyer for a very specific purpose.
Yeah,
To evaluate a transaction, to get you out of trouble,
yep,
to figure out whether you're in trouble. And so that's the first thing is make sure you have limited, what you know and know what you don't know, which is really a self-awareness kind of thing. And then make sure that the person you're asking advice for is on your side.
yeah.
And that's the best you can do, I think.
So how do you, maybe as a follow up question to that, I was rereading your article on making smart bets,
Oh,
and I think in the beginning of that article, you talked about, it was about the guy that took you up the mountain there, but he was a mountain climber.
right.
And
He's
so
big.
so
He's
here's
still out
the
there writing books about climbing mountains.
so he's out there and he's out there and he's taking you on this guided tour, and he goes off for some alone time to go climb, you know, a sheer cliff or something. So he's the expert now. As a metaphor, he's the expert, right? But he's climbing a cliff, and you're not really sure. You don't even really know. It sort of like goes back to this. I guess also maybe ties into the topic of black swans too. But you're here. You're going along. You've got this expert who's helping you out. You think you've made a good decision, and for the most part you did. He's getting you kind of where you need to go. But he kind of goes off and starts doing something that you think is really nuts. And how do is there a way to look out for stuff like that? And how do you, I mean, can you manage that stuff? You just never
Well,
know.
that's a great question because that in that case, he was thinking about his own risk,
Yeah,
okay, and he evaluated because he wasn't. Yeah, maybe he was thinking about the downside risk of him falling off that sheer cliff.
yeah.
In all of that downside analysis, he was not thinking about, oh my goodness, I'm going to leave these two clients stranded in the wilderness, because that would have been the least of his worries.
Right.
And so he was evaluating so it comes down to you actually have to not just make sure that that you can trust the individual, that they have your best interest at heart, but also you got to understand what is their agenda.
Yeah.
How do they make money? I mean, because
Yeah.
that's relevant.
Right.
I mean, because you actually will never find an advisor or somebody to help you whose interests are 100%. I mean, I probably that was an overstatement in my book where I said
Yeah.
make sure they're 100%.
Yeah.
On your side, because nobody can be 100% aligned because they're a different individual and they've got their own They're going to have their own agenda and own interests. So, but you can determine what their interests are. So it's really more about transparency.
Hmm.
Is get to know the person that you're giving that's giving you help.
Yeah.
Get to know, enough to say, okay, I can trust this person, and they're generally have my interests at heart,
Hmm.
but also try to understand a little bit about what's driving them.
Yeah. Yeah. I mean, that there's a. Are you familiar with Chris Voss or the Black Swan Group?
The Black Swan group. No,
Yeah.
I don't know the Black
So
Swan.
there's a negotiation teacher. He's a former FBI hostage negotiator, and
Mm-hmm.
his name is Chris Voss. He does a lot of negotiation training.
Mm-hmm.
So he has this an interesting talking about conflicts of interest and trying to make sure somebody's 100% on your side and versus are they on your side, or are they working with you or mostly working with you or whatever. He tells this story. One of the stories that I always found was very interesting was this idea of trying to negotiate, basically in a negotiation, trying to help somebody without hurting them. And he tells a story about a group of students at Harvard, and they're negotiating over this basket of oranges. And when I was like Team A and Team B, and Team A had a certain agenda, and Team B had a different agenda. And so you'd think like these two groups are going to go head to head, and essentially they're negotiating over the same basket of oranges.
Mm-hmm.
And they go back, and for a while they're very unsuccessful. They just can't seem to work out any kind of deal where they both get the oranges, because there's only one basket of oranges, and they presumably both want it, right? And initially the thinking is we're going to have to make some sort of compromise. Maybe we can split the oranges in half or something like that. Turns out that Team A's agenda was to just get the orange peels, and Team B's agenda was just to get the fruit. So once they opened up that line of communication, they just separated the fruit from the peels, and both got what they wanted, and nobody was hurt in the process.
Yeah.
And so I think there's always I've told that story before to clients to say, like, if you're gonna, when you go out there, and if you're not doing business with me, make sure you're doing business with somebody who can actually do that for you, or at least approximate that, right? So that you can get what you want, and they can get what
Well,
they want.
it's the classic win-win
Sure.
situation. I remember actually the first time I met Barry Sachs, my collaborator, he was the attorney for it was the San Francisco Symphony,
Yeah.
and I was the actuary for the San Francisco Symphony, and the musicians were entering into bargaining with the management, and of course everybody wanted the music to continue, and everybody
Yeah.
wanted them to, but there was a basket of oranges, several $1 million that had to be
Yeah.
figured out. And they had hired a guy from the Harvard Business School. I think his name was Mnuchin,
Yeah.
and his whole thing was interest based bargaining,
Yeah.
which is that if you share your interests with the other side, which is not something that unions and management are typically
Right.
wanting to do, you actually get to better answers. And the system worked pretty well. I mean,
Mm-hmm.
they avoided a strike, and
Well, that's
the
good.
music went on. But it's an interesting point. Exactly what you're saying
Yeah.
is that a good advisor and somebody who wants to help you should not be shy about sharing why they're doing it and
Yeah.
what they're going to get out of it.
Right.
I mean, a lot of them will say, "No, I just want to help my clients," but yes, but they also are going to get compensated in some kind of way, and
Absolutely.
maybe they're also trying to build business. So
Yeah.
helping you is a means to an end. So of course, it's great to work with somebody who's giving you a good deal so that they can build their business.
Yeah.
So but so your point is absolutely on the mark.
Is there
Yeah.
something? Is there something in particular that you want say to people who might be watching this video that this will probably be posted in a couple of different places, and I promote these videos through my email list and a couple other places too. If somebody wants to get a hold of you, or they want to reach out to you or grab any of your books or something like that, how would they do that?
Well, I have a website, and you have my email, and I'm happy to post my email, Pete Neuwirth at gmail.com, and
Okay.
I respond to those. And I do have a website. Um, I would just say that, look for some new research and some new stuff I'm going to be coming out about decumulation, because the
Okay.
decumulation problem is, I think, the one of the biggest problems facing uh, those who are 50 years up and over, 50 and up, as they think about how are they going to survive on their assets, because the government's not going to do it. Defined benefit pension plans are not going to do it. You're basically on your own.
Yeah.
But there are techniques and there's methods, and Barry and I are taking a deep dive into the problem, and
Hmm.
we think we're going to come up with something. And life insurance will have a part in that solution. So
Interesting. Interesting. Well, I can't look forward to it. I know I've enjoyed your work so far, and yeah, I can't wait to see what you come up with.
well, and thanks a lot, Dave, for having me back on, and thanks for I mean, like I said, you're one of my early readers, and I really enjoy tossing these ideas around with you, and look forward to talking again sometime.
Well, thank you. I look forward to talking to you again, too. And also, thank you so much for publishing these books. Because, like I said, I mentioned before, this is it. It's nice to be able to just have a resource where I can say, here, you know, just go here. Like, this guy knows what he's doing, and he's got some great information. And I mean, it's not my it's not my area of expertise. It's not like I sell information on how to make better decisions or anything. It's nice to have, and plus I feel really good about it too. I feel really good about helping people become more independent and less dependent on on me and just other people too. It's like my son is he's going on 3, and it's been fascinating to watch that development go through. And I think this sort of maybe like a metaphor for like whole life. He was born completely helpless, and from day one, it's been this struggle to go towards from dependency to independence. And I think that at some point, unfortunately, a lot of times that development stops. And I feel like every once in a while I come across information or people that make it easier to get back on that track. And I feel like that is sort of a natural progression for human beings, is to move from a state of dependency to a state of independence. And so I just want to thank you for your contributions. And yeah, I'll keep recommending people your books. I just think it's a great piece of information.
All right. Well, thanks a lot, Dave.
All right, we'll talk to you later.
All right, take care.
Take care.